Hello. Good afternoon. Welcome. Thank you so much to everyone at the Institute for inviting me. It's certainly an honor to be here. The idea for this presentation was I sit in New Jersey. I do a lot of work with companies from India coming to the US, and I have a lot of phone calls with people from India, and those phone calls are all very similar, a lot of very similar questions that we talk about. So I thought, let's put it together, let's take all those phone calls and all those common questions and put them together in one presentation and try to address a lot of the basics of the US tax system. I'll be the first to tell you that I don't know anything about the Indian tax system, so don't expect any impact about Indian taxation, but I do know a little bit about the US. So with that, let's just kind of get started. So I've kind of broken this into 5 main areas that we typically see. The most important question is people are always wondering, what kind of business entity should I use if I'm coming to the US? And if I'm going to form a corporation, how do I form that corporation, the incorporation step? What are the basics of US taxation? How does it work? What happens to my key executives that I'm going to send to the US? What's going to happen to them on their individual taxation? And then what's going to happen when I want to leave the US, when I want to exit my business and make my profit and leave? So that's how I kind of see the world, and let's start with going into that. So choosing a business entity. So in the US, we have a few different business entities. This slide has most of them. So let's just start talking about them. In the US, our main legal entity is a corporation. A corporation is a legal entity that is, unlike in India where you have a private limited and a public listed entity, in the US it's one corporation. A corporation can either be privately owned or be publicly traded. A corporation is issued or formed by a particular one of the 50 states in the US. But under the tax code, the Internal Revenue Code, there's basically 2 types of corporations. One is what we call a C corporation, and one is what we call an S corporation. Both are the same corporation as far as the particular state is concerned. This distinction between a C corporation and an S corporation is purely for tax purposes by the Internal Revenue Service. So a C corporation is probably going to be the most common vehicle that somebody from a foreign country will use. A C corporation is a corporation where the corporation is really a completely separate, distinct entity. The corporation pays its own tax, and the only way that an owner of a C corporation is going to be impacted for taxes is if there's a dividend or compensation. Basically, that's it. The other type of corporation, which is an S corporation, is a corporation for legal purposes, but functions very much like a partnership. The corporation itself pays no tax. The owners of the entity pay the tax. One of the requirements to be an S corporation is all your owners must be subject to US tax on a worldwide as residents. So for that reason, you never see an S corporation being used in a cross-border context. It's just good for you to know that, because you may, within the US, domestically, S corporations are very common. So you may hear people talk about S corporations, but because of that ownership restriction, S corporations are not a good fit. For a C corporation, you can have any owner that you want. A partnership is just what it sounds like. It's an unincorporated entity. The partners share the profits. You don't see a lot of this in the US in cross-border transactions, and we're going to get to a slide in a bit that tells you why. Sole proprietorships are very common domestically in the US. I believe they're similar to sole proprietorships in India. It's the easiest way to get started. You simply do work. There's no separate legal entity. Something we don't see in the cross-border context because it's messy. It would mean that person sitting in India would be paying tax as a non-resident in the US, and it doesn't work very cleanly. And then you have an Indian company, maybe an Indian private limited that's coming to the US and maybe just wants to set up a branch. We do see that, and I'm going to tell you why I'm not a big fan of that and why we don't see it that often in the US. Now, you may have also heard of an entity called the Limited Liability Company, or LLC. So in the past 10, 15 years, domestically, LLCs are becoming incredibly common, and they're probably the most common entity that people use to set up a new business. And the reason for that is it's the best of both worlds. The LLC is administered by each state the same way a corporation is. You pick what state you're going to go to, and you have the limited liability to the owners, who are known as members, so they can't be held personally responsible for any debts of the LLC. So that's a great answer. And then the IRS has given incredible flexibility for the taxation of this entity. In most cases, an LLC will be, for domestic purposes, will be treated like a partnership. So you have the benefit of one level of tax as a partnership, and on the legal side, you have the benefit of legal limited liability. If you want, you can make an election to be treated as a corporation, just like the C corporation. So for state purposes, legal purposes, you're an LLC, but for tax purposes, you're a C corp. And then there's a funny rule that says, what happens if that LLC only has one owner or a single member LLC? For US tax purposes, unless we make an election, it's what we call a disregarded entity. It's as if it doesn't exist for tax purposes. So if the LLC is owned by an Indian private limited company, then it's going to be treated as a branch of the Indian private limited company doing work in the US. If the single member LLC is owned by one individual who's an Indian resident, it'll be treated as if that Indian resident is doing work in the US as a sole proprietorship. So they could still form the LLC, but if we realize that that's not a good tax answer, we may make an election, also known as check the box, you may hear that term, to treat that as a corporation. Okay, so that's why LLCs between LLCs and C corporations, you're going to see those entities probably the most. And like I said, the last bullet is the most important, because many times your clients will go to an attorney, they'll set up the LLC because that's what everybody does in the US. And in the US context, you might want to be a partnership, or you might want to be a disregarded entity, but in a cross-border context, you might not. You may want to be a corporation. So the default treatment in the US is, if it's a domestic LLC, that it's considered a partnership or a disregarded entity. So you would have to make an affirmative election within 75 days to check the box to become a corporation. So that's an important deadline to know. So let's say you've decided to form a corporation, and actually these rules also more or less apply to LLCs too. How do you do it? Well, in the US, there's a pretty clear division between what accountants do and what attorneys do. And the formation of entities is something that really attorneys do, accountants don't do. I know in other parts of the world, those lines get kind of blurred, but in the US, they're pretty separate. So what I'm going to talk about in this next module, I'm not qualified to speak about, but I'm going to speak about it anyway. Where and why to incorporate? The first question everybody always asks me is, well, I should incorporate in Delaware, right? Why Delaware? Delaware has some very favorable corporate, not tax rules, but corporate law. But my understanding is that those advantages really help you if you're part of the Fortune 500. You're a big company. If you're a privately held company, you probably don't need those special benefits of those laws in Delaware. And so I think a lot of the reason why people incorporate in Delaware tends to be a myth. I'm a believer that you really should be focused on your business. The business should drive the decisions. If you know that your business is going to be in a certain state for whatever reason, that's where your customers are, that's where your suppliers are, 9 times out of 10, that's the state where you should form the corporation. The question becomes, sometimes you don't know, or you're going to be involved in multiple states. So the one benefit Delaware has is you can be formed in Delaware, and as long as you're not transacting business in Delaware, you don't have to file an income tax return in Delaware. So for clients where you're going to be operating in many states, or you really don't know where you're going to be, or you may not have any physical presence in the US at all, you may be really an IT-based company that you need a US corporation, but really all the physical activities taking place outside the US, Delaware is not a bad state. There's other states too, like Nevada and Florida that don't have that have very favorable rules. The other thing to keep in mind is that if you are going to be making significant investments, all of the 50 states are hungry for investments. And there's a number, there are consultants who focus on helping you get the most benefits you can from the states. And these are usually one-on-one negotiated deals for different types of tax holidays that states are looking to do to gain foreign investment in their state. So if it is a capital-intensive business, you definitely want to be considering that if there is some flexibility as to where your business could be located. So some of the steps is once you've figured out what state you're going to be in, usually the state's website will let you see if that name is available. Because if another entity has the same name, you're not going to be able to operate in that state. So you're going to check that. There is some registration fees to form the corporation. There will be annual reporting. This has nothing to do with tax. This is the corporate law. In Delaware, there's actually a franchise tax that you pay that's based on the assets in the corporation. And that can usually be a few $100s to $2,000 or $3,000. And if you're a highly capitalized company, it could be more. Now, what will happen is if you're formed in a state, if that's the state that you're operating in, so if you form in New Jersey and you're based in New Jersey, then everything's easy. If you're formed in one state, say Delaware, but your operations are in either a different state or they're in multiple states, you have to go to the Secretary of State of each state and do what they call be authorized to do business in that state as a foreign corporation. So in a state context, a foreign is one of the other 50 states. And it is required that you have a registered agent in that state. And this is as simple as hiring a service to be a registered agent. If somebody tries to make a claim or sue you, there has to be a domestic agent in that state. So one of the things you have to consider when you're looking to, say if you're going to form in Delaware, you're going to be paying the fees in Delaware. Then you're also going to be paying registered agent fees in Delaware. And then you're going to be going to the state that you're really doing business in, New York, New Jersey, California, and you're going to be paying fees on an annual basis to be authorized as a foreign corporation to do business in that state. So those fees can add up, so just keep that in mind. Now, how do we actually incorporate? You really should use an attorney that's qualified to do business in that state. They're going to be able to guide you. Some of my clients don't want to spend the money for an attorney. They say, Vinay, you do it. And I say, no, I can't do it. So in that case, there are online filings that you can do. I just listed one website that I happen to use a lot, but there's a number of them. And you can also actually go to the state's website and do it yourself. And you know, it's easy to do the second or third bullet informally if there's only one shareholder. But it's really important that if it's a joint venture and you have more than one shareholder, that you do have an attorney involved, because you need to have a shareholders agreement that's really going to dictate what's going to happen. How are we going to treat this venture when times are good, and more importantly, when times are bad? What are we going to do if we can't get along? Those are all privately negotiated plans that really belong in the shareholders agreement. And it's much better to take care of those up front when you're starting, when everybody is working together, friendly, optimistic. And now that you've formed the corporation, what are some other matters? You have to go to the IRS and you have to get a federal tax ID number. One of the questions on the application is they want the name of a responsible person, somebody who's going to take, not personal responsibility, but the key point person at the IRS. And you know, in India you have PAN numbers, in the US we have Social Security numbers. So the Social Security number is a very important number. So if you have somebody in the US who has a Social Security number who's going to be the principal officer, you can get this number online in a matter of minutes. If you don't have somebody in the US who has a Social Security number, you can still get that number, but it takes about a week or two, and you have to get it manually through the IRS. That's an important number because, like a PAN number, so many things for a company are based on their federal employer identification number. So it's either FEIN or referred to as just as an EIN. So that's usually the second thing you do after you form the corporation. And then the third thing you usually do when you form the corporation is you open a bank account. So once you have your EIN and your corporate articles of incorporation, you have a bank account. So, you know, this whole process can be done in as fast as a day or two if you have somebody with a U.S. Social Security number. If you don't have somebody with a U.S. Social Security number, this can take a week or two. But it's much more streamlined, and I think many of the clients I deal with from India are kind of amazed about all the things that you don't have to do. It's very streamlined. So now let's talk about the basics of US taxation. So if I'm a C corporation, I've put and let me say that for the next few slides, we're going to talk about the federal system. So in the US, you have the federal system, and then every one of the states has their own state system. So let's deal with the federal system first. So if I'm a C corporation, I'm subject to tax on my corporate income. Now, there's a lot of slabs here, but the main takeaway is as long as your income is less than $10 million US, you're going to pay more or less a flat 34%. Okay, if you notice that in the 1, 2, 3, 4, in the fourth line, it goes up to 39%. So the reason for that 39% is you lose, as you get to 300,000 or 100,000 in income, you lose the benefit of those lower tax rates. So that when you get to 335,000, you're at a flat 34%. So for simplicity's sake, 34% is going to be the corporate tax rate. And if your income is well over 15 or 18 million, you're going to be at a 35% corporate tax rate. So how does the tax structure work? So we pay a corporate income tax, which is my revenues minus expenses on a US tax basis, and that's going to be at the 34%. So now what happens when the corporation wants to pay a dividend? Well, in a domestic context, if I'm paying dividends to a US owner, the owner pays the dividend tax on their personal return. So unlike India where you have a dividend distribution tax, the corporation only pays one level of tax, and then the second level of tax is paid by the owner who receives the dividend. Now, if my owner is a non-US shareholder, the IRS doesn't trust that non-US shareholder to file a tax return and pay tax on their dividend. So in that case, the US corporation has a withholding obligation of 30% generally is the statutory rate on any dividend paid to a non-US shareholder on that dividend. At that point, then we'll talk about the treaty exceptions in a minute. So you still have the two levels of tax, but there's a difference between how the US treats and how India treats who pays that second level of tax. So in non-treaty countries, it's 30% rate. For companies coming from India, 15%. Also, many investments through India come through Mauritius. The US has no tax treaty with Mauritius, so from a US point of view, Mauritius is not a great country because you have a 30% tax rate on dividends paid to Mauritius, or Singapore for that matter. Interest expense, what happens? So my Indian private limited puts money in as debt into my US company because we like debt because we can make a debt payment and repay principal tax-free. So what happens to the interest that we have to pay? So general rule under US statutes, 30% of the interest is subject to withholding. There is an exception known as the portfolio debt exception, which is really to encourage foreign non-US people to invest in the US, which basically calls for no withholding, but that you don't see that very often in this cross-border context because you cannot be an owner or own more than 10% of the US corporation to take advantage of that. Under the US-India tax treaty, you have a 15%, the 30% is reduced to 15%. The US, like many countries, also has thin capitalization rules because what the US doesn't want is they don't want you really putting in money as debt, putting money and calling it debt, and it really is equity. So if you're too highly leveraged, then there's going to be limitations on how much interest you can deduct. Okay, so I said in the beginning why we don't like branches. If I set up a C corporation, thank you. If I set up a C corporation, I am always going to pay tax on the income, we know that. And when I pay a dividend, I'm going to pay the second level of tax. Either my US shareholder is going to pay it or I'm going to have the withholding tax. So if I come here as a branch, the branch is going to file a US tax return and it's going to pay tax on its income or expenses that relate to the US operations. But because there's no separate entity, there's no dividend being paid to the home office. So it would seem like a great vehicle to get away from that second level of tax. So because of that, the US tax code has something known as the branch profits tax. And what the branch profits tax is designed to do is it's designed to be a replacement for that second layer of dividend tax. So in theory, that's what it does, and in theory, everything works exactly the same. In practice, it doesn't work so well because the branch profit tax is imposed when there's a so-called deemed dividend. And a deemed dividend is when I look at my balance sheet at the end of the year, and if my income is positive, but my US equity on my US books is decreased, the tax code says, okay, to the extent that your equity decreased, that's considered to be a deemed dividend, and now you owe this branch profits tax of either 30% or 15% under the treaty. In practice, it's very hard to control that, and oftentimes we'll be sitting here after the year is over looking at the balance sheet and say, oh no, we failed the test, our equity went down, and now we have this branch profits tax that we didn't expect. So for that reason, it's just too easy to have this unexpected branch profits tax, which, this is my personal opinion, why I don't like the branches. With a C Corp, I can control exactly when I send a dividend and when I don't send a dividend. With branches, I can't. Now, in some sort of advanced planning scenario, sometimes branches do have a role, but for the SME type market, generally branches are not good setups. And now, how do we have a branch? We have a branch if we have, under the U.S.-India tax treaty, a permanent establishment. And I'm guessing that permanent establishment is a concept all of you are familiar with. It can be a number of things. Under the treaty, the general rule is 90 days or less during a 12-month period. If I have 3 U.S. employees, 3 Indian employees in the U.S. on the same day, that's 1 day, not 3 days. So that's a good rule. But that 90-day rule is really something that we have to monitor very carefully. And many of you are going to be familiar with the Article 12 of the treaty, which takes away that 90-day benefit when you have fees for royalties and related technical services. So that's actually a very sticky area that you have to watch out for when you're thinking about branches. Now, this is probably one of the most important things if you have a branch in the U.S. You have to file a protective return. So if you have a branch, the form that you file is an 1120-F. So you may go through your analysis and say that I don't have a permanent establishment in the U.S. because I've never spent enough days there. I'm not doing enough business to give rise to a branch. So if you file, if the IRS comes back and later determines that, no, we disagree, you really are a branch, and you never file an 1120-F, then the tax is imposed on the gross revenue of the branch with no benefit of deductions. So that's a horrible result. What you have to do is you have to file a protective return, a protective form 1120-F, and there's a box to check called protective return. And you attach a statement saying, I'm taking a treaty-based return position that I don't have a branch in the US. And in that case, then if the IRS disagrees with you and you're audited and you lose, then you're subject to US tax on the net income of the branch. So huge difference, but it's very important to file that treaty-based disclosure form if you're going to come into the US. And what that means is that you have to get a USEIN number, and your client may say, I don't want to do that, I don't want to get into the Indian system, the US system, just like my US clients say, I don't want to get a PAN number, I don't want to get into the Indian system. But it's really important to do this because the downside is very bad. Okay, why don't I like partnerships in a cross-border context? Because in a partnership, somebody's paying the tax. Okay, what happened here? Okay. In a partnership, somebody's paying the tax. The partnership itself is not paying the tax, the partners are. So if I have a US partnership with US partners, each partner gets a sheet of paper that tells them their share of income for the partnership, from the partnership. They include that on their personal tax return, and they pay the tax. If the partner is a non-US person, who's going to pay the tax? The IRS wants somebody in the US to be the withholding agent, and in that case, it's the partnership. In the case of a partnership, the partnership, so if I'm a 50-50 partner, if I have a partnership with 2 partners, one US, one non-US, and I have $100 of income, my US partner is going to include $50 of tax on his US return. The $50 that's allocated to the non-resident partner, the partnership has to withhold the 30% on that partner's 50%. Now, The problem is that withholding is due regardless of whether any cash is distributed by the partnership or not. So there's oftentimes a liquidity problem because any growing business is going to be taking its cash and reinvesting it. And now the partnership has to find the funds to withhold, which is effectively a distribution to that partner, and send that to the IRS. So that's one of the reasons why we don't like partnerships in the US, in a cross-border context. So we've been talking up to now about federal taxes. So now let's talk about the states. States, unfortunately, there's 50 different sets of rules of state taxes. The good news is most states will adopt the federal taxable income, your calculation of federal taxable income, as the starting point for the income for that state. And then they'll make their own modifications. So one very common modification is for federal purposes, we're allowed accelerated depreciation on many things. Many states, because of budgetary problems, will disallow that. So we'll often compute two sets of depreciation, one for federal purposes under the accelerated depreciation and one for the state system, which is slower, and that difference will be an adjustment that we compute. So most states adopt the federal base. Unfortunately, New Jersey is one of the few states that has their own entirely different system, so that makes my life interesting. The other challenge with state taxation is every state has its own model as to how they're going to take the federal income and allocate it to each state. And most states do not have a specific accounting approach. So you would think that if you have one office in New York and one office in California, you'll keep two separate set of books, and you'll pay New York the income that was earned in New York, and in California the income was earned in California. It doesn't work that way. New York will take the federal income and they'll divide it. They have their own formula based on whether you're selling services or tangible property to come up with the income tax subject to tax in New York. And California will do the same thing, and they'll have their own system. And so there's no guarantee that you're going to pay state taxes on 100% of your income. It could be less than 100% of your income, or it could be more than 100% of your income based on which states you're in. So state tax planning is something we try to do whenever we can to avoid paying taxes to different states at more than 100% of the federal base. So all states need money. So they're trying to bring in as many states as they can, and many companies as they can to that state. And the term that is very common in the US is what we call nexus. Do I have nexus in a state? So nexus traditionally is based on what's my level of connection. So when I have tangible goods, there's sets of rules about physical connection. How often are my employees going into that state? Do I have an office in that state? Am I sending deliveries into that state using my own trucks? Those are all things that the different states will use. The treatment of electronic commerce and services is actually a very hot issue in the US right now because there's two different states have adopted one of two different methods as to how to allocate that income. Some states will base it on where the service is being performed, and some states will base it on where is the customer based. So I'll give you an example that we're facing in our firm right now. New Jersey is a state that looks to allocate services based on where the services are performed. And New York is a state that looks to say where's the customer. So in our office, which is based in New Jersey, we have many New York clients. We do most of the work in New Jersey. So New Jersey wants most of our income taxed to New Jersey. Most of our customers in New York wants most of our income too. So in the case of our firm, we're going to pay about 150% of our income to the two different states. And then another trend is what they call economic nexus. Because the economy has transformed over the last 20 years, you don't have to physically be in a state. States are saying that if you have more than X number of dollars of sales in our state, we're going to consider that you have economic nexus and we have the right to tax you. So California has an economic nexus statute. A few other states do. That's something that's still, the states have taken that position. There's still a lot of people don't like it. A lot of people believe that that's not allowed under the federal law. But that is something that exists. So let me talk about employees, payroll taxation. If somebody's working for me, I have they could be one of two things. They could be my employer, they could be an independent contractor. Now, The IRS and state tax authorities like employees. Why? Because as an employer, I'm going to pay my own employer payroll taxes, and I'm going to withhold payroll taxes from the employee. They don't like independent contractors because that isn't there. But the employers would like everybody to be an independent contractor. They're giving the person a check, no withholdings, the employer is not paying any tax, and so obviously there's a difference in what each side would prefer. At the end of the day, we have to look in to see who controls how the work is being done. And the more control the employer has over, who does the work, when it gets done, working hours, business cards, all those things, that tends to look like an employment-based relationship. If somebody's hiring me as their CPA and all they care about is they get their tax return done on time, that's an independent contractor relationship. So sometimes as your clients go into the US, this is something people just don't want to deal with, and they want to set up everybody as an independent contractor. And that's really not something you should be doing. It's really good, it's really important to set people up as employees from day one if they're completely dedicated to the new venture or to the new business. The payroll taxes in the US at a federal level, 6.2% on the first 118,000 of wages. So that's what we call FICA. And there's two sides to that. The employer pays one side, which is 6.2%, and another 6.2% the employer withholds from the employee. So 12.4% in total on the first 118,000 in wages. And then 1.45% is what we call the Medicare tax. Again, that's 1.45 paid by the employer, 1.45 paid by the employee on an unlimited base of wages. Okay, so these are the two main payroll taxes in the US. States have their own payroll taxes, but those tend to be much smaller dollars. Okay, you may have heard of the Affordable Care Act. It's also called Obamacare. This is the new trend in the US that's requiring all employers to give health insurance to their employees. It's very controversial, very complex. Nobody understands it. Just know that if you have more than 50 employees, this impacts you. If you have less than 50 employees, it probably does not impact you at this time. Sales and use tax is really the main indirect tax that we have in the US. It's imposed by the states. And for the most part, sales and use tax are still statutes based on the old economy of tangible goods. So for the most part, if you're selling a tangible good, it's probably going to be subject to this tax. If you're selling a service, it's probably not going to be subject to the tax. But every state is different. And why is it important? Because if I'm selling computers and they're subject to a sales tax, I'm going to collect the sales tax at the time of sale and remit it to the state tax authority. If I don't collect this, if I make a mistake and either don't know about sales tax or I take the position that for whatever reason the sale of this computer is not subject to sales tax, and the state later comes back to me and says that it is subject to sales tax, now I'm not going to have very much luck going back to my customer a year later and trying to collect the sales tax. Now that's going to come out of my pocket. So these types of indirect sales tax issues are very important to identify up front when you have a new company coming into the US. And just like we talked about nexus for the income tax purposes, there's also a concept of nexus for sales tax purposes. So I have to look and see, does that state that I'm selling into have the right to tax me? And you could have a situation, those are two different standards. So you could have a situation where I'm required to pay the indirect sales tax, but I'm not required to pay the corporate income tax. So let's talk about, now I've got my US business, I formed a corporation, I understand the nuts and bolts of how the mechanics work. Now I'm going to send some people over to work here. So the basic premise that Kirith mentioned earlier on is that in the US, if I'm considered a resident, I'm taxed on my worldwide income. Doesn't matter where I am, where I earn it. If I'm a non-resident, I'm only taxed on my US sourced income. So how do I go from being a non-resident to a resident? If I'm a resident if one of three things. I'm a US citizen, if I'm a green card holder, or if I meet something called the substantial presence test. So it's pretty clear if you're a citizen or a green card holder, but what about the substantial presence test? People always ask me, how many days do you have to be in the US to be subject to US tax? And I wish there were an easy answer. It's not, you have to go through this formula that basically looks to see how many days were you in the US in the current year, and also how many days were in the US in the year before that and the year before that. and you look to see, you go through this formula where you count 100% of the days in 2016, a third of the days in 2015, and a sixth of the days in 2014. And if adding all those up together, it gets you to 183 days, and you've been in the US 31 days in the current year, you're a tax resident. Okay, so many people come to the US with this misconception that I'm not going to become a resident until I get a green card, or until I get a green card, and that's completely false. So this is something you have to watch out for. And that's just an example of somebody who was in the US 100 days in the current year, but is still considered a resident because they were in the US a lot in the prior years. And if you notice in my example, in no year was somebody in the US more than 183 days. So it's not a mechanical 183-day test. So you're sending somebody to the US, what are some things that we can do? Because if they know they're going to come to the US and they're going to end up being US tax residents, maybe there's some things we can do. If I have sales, I'm not taxed on the value of the assets that I own when I come to the US, but I am taxed on gains and income. So if I have unappreciated gains, maybe I want to realize those, at least from a US perspective, so that I'm not paying that gain in the US. If I have stock options, maybe I want to exercise them. Maybe I want to make a gift to family members to get assets out of my name. But those are all things you can only do before you come to the US and before you become a US tax resident. So that's a critical thing to be thinking about. So now let's talk about leaving the US. I've got my business, I've been successful. One of the good things about C corporations is if I'm a non-resident shareholder in a US C corporation, I sell the shares, there's no US tax. Okay? For US purposes, that's not US sourced income. It is foreign sourced income and there's no tax. So this is probably the most common exit that we see from a foreign investor coming to the US. One of the reasons why they want to buy shares is they'll be not subject to US tax. Now, what if my C corporation sells its assets? In that case, I have a double tax. The corporation itself will pay tax, and then, assuming that I don't liquidate the corporation, how do I get that money out? It becomes a dividend subject to 2 levels of tax. So you may ask yourself, well, why wouldn't I just sell my shares? Why would I ever sell my assets? Well, there's a conflict between buyers and sellers. A seller, even in a domestic context, will always want to sell shares because one level of tax, capital gains, the seller benefits. A buyer will always want to buy assets because they're going to get a step up in basis of the assets, they're going to get the fair market value, and then they're going to be able to amortize those assets based on whatever the life is. And for goodwill in the US, you can amortize goodwill over 15 years. So even if the buyer is buying basically all the purchase prices for goodwill, they're going to get a 15-year write-off. They do that same purchase, and by buying the shares of a corporation, they get 0 write-off and sitting on their balance sheet. So I've actually seen many deals fall through where the tax bill was so huge that the buyer and seller just couldn't come to an agreement. So my point is that you may not have a choice when you want to exit, that you can sell the shares in a share sale. Another thing we didn't talk about is real property. If you own real property or you have a corporation that owns real property, it would be really nice if I could have my corporation own real property, then sell my shares in the corporation, not pay any US tax. There's rules to prevent that, known as FIRPA. And basically what will happen is that if I'm buying property from a seller who's not a US person, I have to withhold 15% of the sales proceeds, and then that foreign seller has to file a US income tax return, calculate the gain, and get the refunds back. So real estate is really it's a unique animal. So some other closing thoughts of things that I see. Well, I get a lot of questions about transfer pricing. So here's my informal point of view. The concepts that I see in India and the US for transfer pricing are generally the same. I think the Indian tax authorities tend to be more aggressive in transfer pricing than the US tax authorities, but the concepts are the same. When I have clients that are coming to the US from India, in almost all cases they will have a a formal transfer pricing study done for Indian purposes. That's much less common in the SME market in the US. And depending on the number of dollars involved and the number of related party transactions, sometimes we'll just say, okay, you've got your Indian transfer pricing study. As long as you're being consistent, we'll live with that, and we won't do anything else in the US. The analysis will be we'll use that analysis to be our US-based analysis. And then at some point, and I can't give you a dollar because it just goes by my gut as to the client, sometimes I think, okay, now we really need to, we're getting to the level where the IRS may ask us for a US-based transfer pricing study. So what we'll often do is, if the Indian companies had a transfer pricing study done by an Indian CA firm that has a US affiliate, maybe a Big Four, we'll have that Indian transfer pricing study modified to meet the formal US requirements. There's a code section 6166 that has the provisions of what a US-based transfer pricing study has to be. They're generally very similar. But if you wanted to do the best you can do, you would have that Indian transfer pricing study validated for US purposes. And I would say up until 2 or 3 years ago, transfer pricing was not high on the radar of the IRS for the SME market. It was really the large, companies with sales of more than 500 million. Now I think the scope is creeping down, so at least on my personal radar, it's becoming more of an issue with clients that might have sales from 50 to 100 million. I haven't talked about any tax forms today, but the one form I want to talk to you about is Form 5472. That's a form that if you have a US corporation that's owned by a foreign party, you have to file that form, otherwise there's really big penalties, and you have to disclose the foreign transactions. Disclosing the foreign transactions is not a big deal, but one of the things that I often find as a problem is that in that form you have to disclose who the direct shareholder is, and you have to disclose who's the ultimate indirect shareholder if anybody owns more than 25%. So usually there will be a promoter at the top of the chain that has, and you look at family attribution rules to make this determination. You'll have a promoter, or you'll have somebody who owns ultimately 25% of this venture. And frequently I get pushback where that person doesn't want their name going to the IRS. So I always bring this out up front with the clients that does have to be disclosed if you're going to be having a foreign-owned corporation and you own more than 25%. The other question that comes up from time to time is I've had an executive, he's here in the US, we've wound up the business, and now that executive is sick of being subject to US worldwide taxation, they want to give up their citizenship or green card, what happens? So the US has an exit tax. If I'm a US citizen and I decide to give up my citizenship, if my average income over the last 5 years has been more than about 150,000, or my net assets have been more than 2 million, it's as if I sold all my assets, I get one exemption of about 680,000, and then I pay tax on that phantom gain. So that's the rule for US citizens. I think what comes to a shock for a lot of people that if I have a green card and I've held it for more than 8 years, those exact same rules apply to me. So somebody who has a green card, doesn't really think of themselves as a citizen, could be subject to the same exit tax. So it kind of gets back to the pre-immigration tax planning and really considering somebody's long-term plans, figuring out where they're going to be for the long term before they get too wrapped up into the US tax system, because it's easy to get in, it's hard to get out. And I think that's the end of my remarks. So I think we have time for questions, right? Yeah. About this or anything else on the US side.
Friends, we shall keep the floor open for any questions, if at all. Yeah, one by one.
For a person who is an Indian citizen and he has come recently to United States, whatever income he has got in India, for example, he has got pension, he has got provident fund, he has got some shares, dividend. he has got some fixed deposit interest in Indian companies. Would they